for today's video, we'll look at the uses of the general journal. And there are different uses, such as the purchase and sale of fixed asset, the writing off of bad debts, other adjustments, entries to be in the new set of books, and of course, correction of errors. So for today's lesson, we're going to look at the purchase and sale or sale of fixed assets. We'll also look at the writing off of bad debts. We will look at other adjustments, and we'll also look at the opening entries for a new set of books. In another video, I'll look at the correction of errors. There are two types of errors: errors affecting the trial balance and errors that do not affect the trial balance. So let's get to work. So basically what we're doing is the double entry, but we're doing the double entry in the journal. So we'll need the date, the details, account to be debited, account to be credited, and the amount. All right. So let's go ahead now. So the purchase or sale of fixed asset. The first thing we do is, of course, we have to put the date, 2024 and March 1. Remember, we're doing the double entry in the journal. So instead of doing it in the ledger, we're recording it in the general journal. So the accounting double entry rules would be wise to understand and mastered by the time we reach this level. So let's go. We bought motor car on credit. So we have an asset and we have a liability. When asset increase, we debit, liability increase, we credit. And of course, the motor car is an asset. So we're debiting motor car. And we know the folio is general ledger, and the amount of money would be $500. Now, if motor car is debited, the other account, which is ATL Limited, would be credited. So we put ATL Limited, and of course, going to indent at all points when we're recording the account to be credited. And the folio would be PL because, of course, we owe them money. We purchased something from them, and then the amount $500. The last thing we'll have is what we call the narrative. All right, and we put the narrative there. And something short just to tell what happened. We bought motor vehicle on credit. The second one was where we sell an asset. All right, so March 7. And in this case, the asset is decreasing. The office computer is decreasing. When asset decrease, we credit, which means T Sangster will be debited because T Sangster now owes some money. So we sold him on credit. So let's go. T Sangster will be debited. The folio is SL because it's a customer. We sold to them. And of course, $350. The other account, office computer, the asset is decreasing. When asset decrease, we credit. And then we put that to GL as we know. And then it is $350. So that's that for the first part, for purchase or sale of fixed asset. Let us look now at writing off of bad debts. The truth is, when our debtors for assets owe us money, we always debit their account. If the debt become bad, that means that they're not in a position to pay us anymore, which means we have to write them off. So it means they could become bankrupt, probably their business shut down, they have died or something. So that money will not get back. So that is bad debt. The debt has become bad. We won't be able to get back these money. So what we'll have to do is to write off the account as bad debt. Debtors are always debited when they increase. But if it's going to be reduced, because it's written off, if they don't owe us anymore, it will be credited. So of course, the debtor R Brown, his amount that he owes would be reduced, so would credit R Brown. And of course, bad debt would be an expense, and therefore we have to debit expenses. So of course, we have to put a narrative for the T Sangster that we sold the office computer. So March 17, we debit bad debt, which is the expenses account. Expenses are always debited. It goes to the general ledger, and the amount was $88. Then we move on to R Brown. And R Brown is a debtor. Debt has been reduced. He does not owe us anymore, so therefore we credit. When asset decrease, we credit. And of course, we'll find his information in the sales ledger. And of course, it is $88. And that's how we do the writing off of bad debts. Let's move on now to other adjustment. So on March 19, another debtor, H. Finley, was unable to pay us his account. So, we had to put a narrative, of course, bad debt written off, just put that for the narrative to basically describe what happened at March 17. So, another debtor, as we were saying, at March 19, H. Finley could not pay us any money. Luckily, unlike R. Brown, H. Finley was able to give us an equipment to settle his or her debt. So let's do that now. The asset of the debtor is decreasing, but we've got another asset which is increasing in the business called equipment. So just go March 19, equipment. Asset is increasing, we've got an equipment. And if asset increase, we debit. And of course, fixed assets, they all go to the general ledger, and the amount was 296. The other account in the transaction is H. Finley, a debtor, and this debtor's amount has decreased. When asset decrease, we credit. So it's double entry we're doing in the journal. And of course, H. Finley would find in their sales ledger, just like R. Brown, because they're customers. And the amount is $296. So that is how we do the purchase or sale of fixed asset, the writing off of bad debts, other adjustments when we're using the general journal. The last thing we'll look at in this video is how to record opening entries for a new set of books. Pretty double entry. Straightforward. So on April 1, the next month, we decided to open a new set of books in order to keep better financial records going forward. Our resources owned and owed are listed below. Resources owned are assets. All right, we know assets are always debited when they increase. And then we have liabilities. Liabilities are always credited when we don't have capital. So it looks like we lost track of our capital and we need to have our capital figure. And we know really and truly to find capital, it is A minus L. So just for you to remember, the accounting equation is A is equal to C plus L. Asset is equal to capital plus liabilities. If we want to find capital, we transpose the larger number minus a smaller number to the total assets minus our liabilities. And that's how we'll find capital in this question. So let's go. First we do, of course, it's the date. So we write the date. April 1. And what are our assets? We have building, we have fixtures, stock, debtors, and we list all of our assets first. Then we're going to list our creditors. And our creditors are, we have TL hardware and we also have mortgage. Those are our liabilities. After we have listed our liabilities, then we know we have to leave a space for capital, draw our total line, and look at how much our assets have come to. All right, so our assets came to $16,000, and we need to subtract the total liabilities now in order to get our capital. So 4,300 from 16,000 would give us our capital. And that means our capital would be $11,700. So all we do for open books, a set of new books, we just list all our assets, we put them down, then list all our liabilities, we put them down there in the general journal, and we subtract our liabilities from our assets to get our capital. And that is pretty much how we actually do the general journal. All right. I hope this video helps. See you in the next video when we look at how we use the general journal for the correction of errors.